Stop what you're doing. This isn't just a lawsuit, it's a financial tripwire, and Washington might be about to yank it. In March 2025, the U.S. District Court for the Southern District of New York ruled that lawsuits filed by over 9,000 American plaintiffs against the Chinese government for COVID-19 related damages could proceed. That decision cracked open a legal door many believed was sealed by sovereign immunity. Now lawmakers, led by Senators Josh Hawley and Marco Rubio, have revived the Justice for COVID Victims Act, proposing the seizure of $7.3 billion in Chinese state-owned U.S. assets, according to Treasury records. Think real estate, corporate shares, frozen bank accounts. China's response? Immediate and incendiary. Its foreign ministry declared the move a blatant violation of international law, warning of unprecedented countermeasures. Georgetown law professor Julian Ku called the precedent a legal grenade that invites global retaliation. So if Washington pulls the pin, how fast does Beijing strike back? And where does the first blow land? The strategy echoes the West's freezing of over $300 billion in Russian central bank reserves after Moscow invaded Ukraine in 2022. But applying the same tactic to China may ignite an entirely different reaction. According to IMF data, China is deeply integrated into global markets, handling over 13% of global trade and serving as the largest trading partner for more than 120 countries, far more than Russia's trade footprint pre-sanctions. While Russia's financial system was already semi-insulated, China's is tied to trillions in US dollar-denominated transactions, tech sector investments, and debt markets. Morgan Stanley's global strategist Seth Carpenter stated in a March 2025 report that China has far more levers to pull and far more to lose than Russia did. Any attempt to seize assets would likely trigger disproportionate retaliation. Beijing's response hasn't come in the form of missiles or sanctions, but something far subtler and arguably more dangerous: market retaliation with surgical precision. And the first pressure point? It's not where most expected. In February 2025, China abruptly canceled grain import contracts from several Midwestern U.S. states, citing biosecurity risks, just days after Missouri's House passed a bill banning agricultural land sales to Chinese companies. Missouri had previously been home to 42,000 acres owned by WH Group, the Chinese parent of Smithfield Foods, according to USDA data. While the state's lawmakers cited food security, Beijing's pullout triggered immediate concern in the U.S. farm sector. This was not about pest control, said Sarah Manker, CEO of agricultural analytics firm Grow Intelligence. It was a geopolitical message disguised as an inspection report. The American Farm Bureau estimates Missouri farmers alone could lose over $1.1 billion in projected 2025 exports. What's unfolding here is a symbolic clash: foreign ownership, domestic backlash, and trade disruption, all converging on soil once seen as politically neutral. But what happens when the conflict leaves farmland and enters the bond market? China's holdings of U.S. Treasuries have already declined from $1.06 trillion in 2021 to $816.3 billion as of January 2025, according to the latest Treasury International Capital data. While Beijing hasn't announced a mass sell-off, analysts at Barclays note that China has quietly trimmed its position for 17 consecutive months, replacing treasuries with gold, euros, and IMF special drawing rights. Although a sudden sell-off would risk devaluing its own assets, the real power lies in its continued reallocation, which has already raised U.S. borrowing costs. The yield on 10-year treasuries climbed to 4.35% in March 2025, partially due to reduced Chinese demand, pushing up mortgage rates and federal interest payments. This isn't a nuke, it's erosion, says Eswar Prasad, former head of the IMF's China division. Beijing isn't crashing the dollar. It's gradually walking away from it. But the retreat from treasuries isn't the only sign of preparation. It's what China's buying instead that's turning heads. Since late 2022, China has accumulated over 300 metric tons of gold, pushing its official reserves to 2,313 tons by February 2025, per World Gold Council data, marking the longest streak of monthly purchases in history. The People's Bank of China has also encouraged domestic banks to increase their bullion holdings and facilitated gold-backed yuan settlement options for international oil trades, particularly with Russia and Iran. According to Bloomberg, Chinese retail gold demand rose 17% year-over-year in Q4 2024 as the government expanded promotional campaigns via state media, urging wealth preservation through national assets. Economist Zoltan Podshar, formerly of Credit Suisse, argues this signals Beijing's attempt to construct a shadow financial system that functions outside US dollar control. Gold, unlike Treasuries, cannot be frozen or sanctioned, making it the cornerstone of what some analysts now call China's post-dollar survival kit. But if Beijing's preparing for that kind of financial conflict, what exactly is the battlefield? On March 6, 2025, China's Customs Authority abruptly canceled 16 major U.S. soybean contracts, removing over 1.8 million metric tons of grain from the trade ledger in a single week. While the official reason cited inventory adjustments, Reuters reports the cancellations followed closely after renewed U.S. discussions about seizing Chinese assets tied to pandemic liability. The USDA confirms that Chinese agricultural purchases in the first quarter of 2025 have fallen 43% year-over-year, with soybeans and pork seeing the steepest drops. According to Bungie's chief economist Christy Shai, this is a political signal disguised as commodity reshuffling. China showing it can inflict economic pain without sanctions. Farmers in Iowa and Illinois, states that collectively exported over $8.2 billion to China in 2023, are already reporting grain stockpiles with no destination, forcing them to sell at discounts or store unsold harvests. But Beijing isn't just pulling back, it's actively redirecting. U.S. agricultural exports to China peaked at $38.1 billion in 2023, accounting for nearly 19% of total U.S. farm exports. But by March 2025, that number is projected to drop below $16 billion based on current shipping trends, according to Bloomberg Agri-Trade. The pivot isn't random. China has ramped up contracts with Brazil, with Brazilian soybean exports rising 28% year-to-date, while U.S. shipments fell. Archer Daniels Midland has already reduced Q2 guidance, citing structural realignment in Chinese demand. For small and mid-sized producers, the sudden vacuum is devastating. Kansas farmer Doug Matthews told the Wall Street Journal, "Last year we sold 60% of our corn to China. This year we're selling to nobody. As profit margins evaporate and input costs remain high, diesel up 12% from Q4 2024 and fertilizer prices still volatile. The domino effect reaches banks, grain handlers, and rural towns built around this trade. But this isn't just about foreign buyers, it's about domestic prices too." The USDA's March 2025 forecast now expects overall food prices to rise 6.4% this year, up from the agency's previous estimate of 4.9%. The spike is being driven by higher meat and grain prices, directly tied to declining export revenues that are squeezing farm margins and reducing supply. Wholesale pork prices rose 9.2% in Q1 alone, while wheat futures spiked 17% after Chinese cancellations created domestic market distortions. According to the Bureau of Labor Statistics, average grocery bills increased by $47 per household per month in February 2025, the largest monthly jump since mid-2022. Consumers are now paying the price for trade war by proxy, said Ethan Harris, senior economist at Bank of America, in a recent CNBC interview. China doesn't need to tariff America to hurt it. It just needs to leave the checkout line. But if food is being weaponized, what other systems might be next? Between threatened asset seizures, agricultural cancellations, and bond sell-offs, what's unfolding isn't a trade dispute. It's a phased confrontation across financial, supply chain, and legal fronts. As of March 2025, China has reduced its U.S. Treasury holdings to a 17-year low, expanded rare earth restrictions to include gallium exports critical to semiconductors, and rerouted LNG contracts to favor Russian suppliers over American ones. The Commerce Department now estimates U.S. export losses to China could exceed $54 billion by year-end. with ripple-through effects on 1.2 million American jobs tied to goods production and logistics. We're not in a Cold War, but we're in a decoupling spiral, said Wendy Cutler, former acting deputy U.S. Trade Representative, in a March Brookings panel. And yet, despite escalating moves from both sides, there's no defined off-ramp, just overlapping red lines and real-world collateral damage. So the question becomes, is Washington steering toward strategic containment or sleepwalking into something much more volatile? Because what China is planning next, it's not about food or finance, it's about technology. Internal memos leaked to Nikkei Asia suggest that Beijing is now weighing a total export ban on key chip-making materials, including photopolymer resins and high-end silicon wafers. If that happens, the U.S. semiconductor supply chain, already under stress, could face shutdowns within 90 days. And this time, it's not just farmers or families at risk. It's defense contractors, tech giants, and the very backbone of U.S. innovation. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.